Welcome back, everyone. Thanks for tuning in to this month's monthly recap. Today, I'm, as always, joined by David Sokolovsky, wealth advisor with the team, who's fresh off paternity leave. So you can see the handsome little fellow, baby Izzy. Show a nice picture of him. So don't mind David's bloodshot eyes in the background as he kind of re-engages and gets back into it. So David, let's kick it off there. Let's recap the month of January.
Yeah, what a month to be away. So in January, we saw a lot of the market volatility that we anticipated and talked a little bit about last year. But as you look at what's driving some of the activity in the market, in 2021, the S&P returned about 27%, and that really prompted a lot of profit taking to start the year. I think we were no different than many investors looking for the opportunity to take profits after a very strong year. But the difference is if you take those profits in January versus December, it buys you another year to offset the tax impact. And as you look at what drove the S&P and really the broader market in general, you saw the S&P was down about 5%, NASDAQ down about 8% for the month, and equity income or high dividend stocks being relatively flat. It was really driven by the high growth companies. So as you take a look around, the top 5 companies in the S&P are mostly technology companies. They now comprise about 21%, and that's where you see a lot is buried in the noise of the indexes. Is you have a number of companies that basically disproportionately represent the overall market. And if you look at the average price to earnings of the top 10 companies, it was about 31, whereas it's 21 for the rest of the S&P. And historically, the average is about 16. So many of the companies that we look at aren't necessarily overvalued, but trading slightly higher than the averages that we've seen. And within the growth and value story, if you look at large, mid, and small, which you can look at as kind of lower risk, medium risk, and higher risk, risk inversely related to size, the growth was down about 9% on the large, 13 and 13 on the mid and small. But when you look at the value, it was down just about 1% for the large, 3% for the mid, and 4% for the small. So the opportunity really continues to be in the high dividend paying stocks, value companies, and companies that really have an opportunity to, one, generate real income, and two, be able to pass along some of the pricing increases that we've seen over the last year or so.
Yeah, and when you look at the month of December was very consistent with what you just said, David, right? I mean, you had dividend stocks lead the way to the upside in December, and a lot of the trends that we saw in December followed through in January. Markets just adjusting to higher interest rates, a tighter Fed policy, and we're at the cycle where the growth stocks and really the high growth stocks continue to fall. And it was kind of the expectation we saw coming into the year. It's played out for the most part the month of January, and we don't see that changing too much. And to your point, profit taking, we did the same. And this is a little bit different as we've seen this high volatility that it's going to probably persist a little bit longer. So we've just been a little more defensive with the profit taking. We haven't rushed to reinvest, and we're mindful of the opportunities because anytime there's a downturn in the market, and this one's no different, it does open up opportunities. So we're watching for those ahead as well.
Yeah, Jared, as you kind of take a look at the Fed, what are some of the actions that they've taken, I think, that could have upset the markets a little bit?
Well, if you look, this is the first time in a long time we differ for market expectation and what the Fed has guided to. Because right now you're pricing in 5 rate hikes for the year. And again, all the way back to Ben Bernanke when he started as Federal Reserve Chairman, really wanted to provide transparency to the market and really talk the market to where the Fed wanted to go with that transparency. And I think the Fed's done a pretty good job of spooking the markets of higher inflation and higher rates ahead. But it's also we think the Fed is going to get a little bit lucky for a couple of different areas: the labor market, inflation, and supply chain, right? So if you think about those in order, these could be areas that the Fed helps to ease some of the inflationary concerns. So for example, with the labor force participation, it's one of the things that's been challenging the Fed over the last 2 years. They printed a lot of money hoping to bring more people back to labor force. It just hasn't worked. But this year you could see that with higher wages, it could bring a lot of people that have been hesitant to come back, as well as hopefully maybe by April, Omicron and COVID are really rearview mirror looking. And as a supply chain and those other things open up, that could ease some of the pressures on the Fed. So we think this year the Fed may only have to raise 3 times overall. And I think as the market adjusts to that reality, you could see some upside of the market ahead.
And Jerry, as we kind of look ahead, some of the challenges from last year and opportunities really haven't changed. It's really only been a month, and the markets do take some time to adjust. But as you look at the ADP jobs that came out earlier in January, you saw a surprise that about 300,000 jobs disappeared, where it was expected that it would be a lower number. And really, that was mostly driven in the service industry. 150,000 of those 300 jobs were in the service industry, and that was related to Omicron, right? So if you think about it, the month of January, the travel has been reduced. People haven't been going out as much, and that makes sense because as Omicron spread throughout the country, people kind of scaled back some of their activities. But we're seeing that reduce now, so there's some optimism into the year kind of rebounding and normalizing in the months ahead.
And when you look at this cycle with the high growth stocks really taking a major hit over the last few weeks and months, it's very reminiscent in certain parts of the .com era and the fallout after kind of a 2000. But I think investors have to be cautious not to overthink certain things and look at relative value, for example, because it was a big thing in 99, 2000, that a stock used to be 80 and now it's 50, that it's a deal, or a stock used to be 200 and now it's 100, it's a deal. But the reality is when you get these high growth cycles, some of these stocks should have never traded to those levels. So you have to be very careful when you look at relative value that stocks are down 40 or 50%, when again, they were probably overvalued to begin with. So you just need to be cautious on those, because as you start to buy relative value, you could still have a lot of downside losses. And that was very similar in 2001 and 2002, looking for those. And you just had to be patient to watch for those ultimate opportunities, because many of these companies are not going to go bankrupt. It's just being patient to buy them as they kind of turn around and eventually fall. And I think that's what we continue to watch for, is don't have to rush to buy many of these. Just patient, look for the trends, look for things to bottom out. And there's plenty of upside if you're patient enough overall. Because as Gene always used to say, it's better to be the second one in on a turn as opposed to trying to catch the bottom. Because if you try to catch the bottom on the relative value, there could be a lot of pain. So as we look ahead, the other thing that we're watching for is the bond markets. First time interest rates could be a signal, and we're watching for that as the volatility will likely persist in the month of February. But interest rates will be a signal to be one of 3 things. Is it a recession that the markets are ultimately going to be worried about? Is it inflation, or are we back on a growth trajectory? So as we look to the data points in the weeks ahead, the bond market will be a good indicator. So with that, we want to thank everybody for tuning in this month. And again, welcome back, David. And we'll touch base next month.
Thanks, everyone.